Markets are at all-time highs. For many Americans, that means their 401k balances have never looked better. But the higher you climb, the thinner the air gets. Are we looking at a sustainable bull run or a warning light on the dashboard? In this episode, we're diving into what's driving the rally, what could derail it, and how this moment connects to real-world wallets.
And the reason this isn't just an academic debate is that what happens in the market ripples into everyday life. If this rally is on shaky footing and we hit an air pocket, retirement balances, college funds, and even job stability can feel it. So I'll be the voice of caution here. When prices are up this much, the margin for error gets thin. Valuations stretch, leadership narrows, liquidity subtly tightens. Those are ingredients we've seen before in late cycle phases.
Fair. But I'll argue that what's propelling this run has substance, earnings resilience, genuine innovation, particularly around AI and the compute/power, infrastructure to enable it, and still plentiful liquidity in parts of the economy. Investors aren't just inhaling hopium. Corporate cash flows are strong in key sectors, and balance sheets for the mega-cap leaders are fortress-like. This isn't 1999 vaporware. These companies sell products used by billions and generate cash in the tens of billions. And critically, AI-related names have accounted for nearly 30% of index gains year to date, which tells you just how central this theme is to the market narrative right now.
Yet history whispers. Markets also looked invincible in 1929 on the back of electrification and radio, in 1999 with the internet, and in 2007 with financial engineering. The narratives then were also about new paradigms. I'm not saying we're fated to repeat those episodes. I'm saying that great stories often accompany stretched multiples. Many valuation yardsticks, price to earnings, price to sales, and the Shiller CAPE are elevated relative to long-run averages. The CAPE ratio, for example, recently touched around 34. That's in the same neighborhood as late 1990s levels. That doesn't predict a top on its own, but it lowers future return potential and increases sensitivity to disappointments.
Context matters. Valuations live inside an ecosystem of rates, inflation, and growth. If the economy threads the needle, growth steady, inflation gradually cooling, and central banks able to pivot toward easier policy, multiples can stay higher than the old averages for a while. And at the company level, we're seeing something real. An AI investment boom that's not just chips, but also data centers, power transmission, specialized software, and the services around it. That capex is supporting earnings and could drive productivity gains.
About that capex boom, booms can overshoot. We've seen cycles where the build-out runs ahead of demand. Think of telecom fiber in the late 90s. Eventually, too many pipes and not enough paying traffic. Today, we're hearing about data centers outpacing available power, long lead times for transformers, and a scramble for energy. If the returns on all this spend don't match expectations, margins can compress. And because a handful of giants dominate the AI value chain, the whole market's earnings narrative hinges on a few decision-makers' capital allocation.
Concentration is a fair concern. However, unlike the 90s, the leaders today have diversified revenue streams: cloud services, consumer ecosystems, advertising, enterprise software, hardware, and yes, semiconductors. Their cash flow funds the build-out internally. It's like a well-capitalized city upgrading its highways. Traffic is already there and rising. Even if some lanes are overbuilt, the system becomes more efficient. Meanwhile, we've seen signs of breadth improving beneath the surface. Semi-cap equipment, industrial automation, some travel and services. That suggests this isn't purely a seven-stock story anymore.
I'd be careful there. Breadth has wobbled, periods of improvement, then reconcentration. Equal-weighted indices have often lagged the cap-weighted versions dominated by the mega-caps. Historically, narrow leadership can persist longer than skeptics expect, but it tends to be fragile when shocks hit. One earnings miss from a titan, a regulatory surprise, or a macro wobble, and the index-level impact is outsized. For a retail investor in a broad index fund, that means your 401k may be more exposed to a small handful of names than you realize, simply because of how weighting works.
Let's talk liquidity and policy, a theme that's helped the market. Despite higher policy rates, there's still a lot of cash sloshing around. Fiscal spending has been supportive. Household net worth has benefited from home price resilience and market gains, and corporations have continued buybacks and dividends. Globally, some central banks are cautiously stepping back from tightening or signaling flexibility. If inflation keeps trending down, it gives the Federal Reserve and others room to ease over time. Lower rates, even modestly lower, translate to higher present values for future cash flows, i.e., they support multiples.
That's the rosy side. The other side is higher for longer. The Fed doesn't want inflation to reignite, so it's been keeping policy tight relative to recent history. Quantitative tightening continues to drain reserves from the banking system. The Treasury has been issuing a lot of debt to finance deficits, which can soak up investor demand and nudge long-term yields higher, competing with equities for capital. Lending standards remain tighter than they were pre-hiking cycle, and not all sectors have fully felt the bite. Higher real rates raise the hurdle rate for investment. They also weigh on valuations over time.
Sure, but the economy has been more resilient than many expected when rates first rose. The job market, while cooling, remains fundamentally stable. Consumers have adjusted, spending patterns shifted, but spending didn't collapse. And companies adapted. They locked in financing at lower rates when they could, trimmed fat, and leveraged productivity tools. Earnings expectations have actually improved in recent reporting seasons, and a majority of companies tended to exceed guidance. That's not what you see in the early innings of a recession.
True, but recessions are often recognized only in hindsight. There's a lag between rate hikes and full economic impact. We're seeing slow-moving pressure points, rising delinquency rates in certain consumer credit buckets, stress in commercial real estate, especially offices, regional bank balance sheet sensitivities, and pockets of profit margin fatigue outside of the tech behemoths. If unemployment ticks up meaningfully, corporate revenue growth could soften, and then the market would have to wrestle with both lower earnings and possibly lower multiples. That double hit is how drawdowns become painful.
On the point of history, 1929, 1999, 2007, useful context, but not fate. Today's leaders print real profits and sit on large net cash positions. The 1999 cohort, in many cases, had neither. The 2007 story was housing leverage and securitization. Household balance sheets today are, on average, not as fragile, and banks are better capitalized. We could see bumps, yes, but the foundation looks sturdier. If AI delivers even a fraction of its promise, automation, new software layers, new industries, earnings growth can keep up with, or even outpace, elevated multiples.
Comparisons aren't about fate. They're about rhyme. In each episode, the protagonists had a compelling story. What made those periods vulnerable was the combination of high valuations and a catalyst: policy tightening, credit cracks, or an external shock. Think through the present. Inflation progress has been uneven. Energy and shipping costs can flare up due to geopolitics, and election year uncertainty can translate into market volatility. Meanwhile, if the productivity payoff from AI takes longer to filter into the broader economy, investors may become impatient with jam tomorrow promises.
Let's bring it to personal finance realities. Right now, market strength has buoyed retirement balances. That's good for confidence and spending. Company stock comp is worth more. Small businesses benefit when customers feel wealthier. Borrowing costs are still high relative to pre-hiking levels, but credit markets have been open. Spreads, broadly, haven't been screaming crisis. If the rally continues on a fundamental footing, you could see credit remain accessible and equity issuance or buybacks proceed smoothly. That keeps the financial conditions thermostat from getting too cold.
And the flip side, if volatility returns and spreads widen, borrowing gets more expensive across the board. Mortgages, auto loans, business lines of credit. Companies might freeze hiring or trim headcount to protect margins. If the market's leadership is too concentrated, a stumble in a few megacaps can drag indices down, and that can dent retirement balances quickly. For someone nearing retirement who's been comforted by recent gains, a swift 10 to 20% swing can change plans even if they never trade a share. That's why concentration risk and valuations matter beyond the trading desk.
We should unpack breadth in plain terms, because it's important. Imagine a relay team where two runners are elite and the other two are average. The team can win races, but if one elite runner stumbles, the whole team suffers because the others can't make up the gap. Market breadth is similar. When a broad swath of sectors participates, industrials, financials, healthcare, consumer tech, the market has more cushion. We've seen some rotation attempts this year, with cyclical sectors perking up as hopes for a soft landing grew. If that broadening continues, it reduces the risk that one sector's hiccup tanks the whole market.
And when those rotations fade, it tells you that the market still leans on a narrow bench. Equal weight and small cap indices have had pockets of underperformance relative to the headline index. That can be a late cycle tell. The market is essentially paying up for perceived safety in dominant franchises, while starving smaller, more cyclical names whose earnings are more sensitive to the economy. If growth slows, the smaller players feel it first. If growth reaccelerates, sure, they can catch a bid. But we haven't seen a convincing, sustained handoff yet.
Earnings are the heartbeat. Recent seasons have seen decent beat rates and steadier forward guidance than feared, especially in tech, travel, and parts of consumer services. The AI spend to save thesis, companies invest in compute and software to cut costs and increase revenue per employee, has legs. It's not just theoretical. Early adopters are reporting workflow improvements. Even modest productivity gains, scaled across the economy, can support real earnings growth without needing unit demand to explode. That underpins why this rally may have durable fuel.
Let's separate the earnings of the few from the many. The mega caps are delivering, no argument. But aggregate index earnings can mask softness underneath. In more cyclical and rate-sensitive industries, real estate, traditional retail, parts of manufacturing, margins are thinner and debt costs higher. If those pockets weaken, the market's PE can look fine at the aggregate, but it's flattered by the giants. That can set up an unpleasant surprise if the giants' growth decelerates even slightly, because the rest of the index isn't pulling its full weight.
Policy is the plumbing. The Fed raised rates rapidly to combat inflation and has kept them elevated to ensure the embers don't reignite. If inflation continues to cool sustainably, a path to gradually lower rates opens up. Markets tend to sniff that out early. Even small steps can matter. Think of it as tilting the playing field a few degrees so that capital rolls more easily toward risk assets. In addition, fiscal initiatives, whether infrastructure, semiconductor incentives, or energy transition projects, create multi-year demand visibility for certain sectors.
Plumbing can clog. Quantitative tightening reduces bank reserves and liquidity buffers. At the margins, that can increase funding stress, especially if something unexpected happens. The term premium debate, how much extra yield investors demand for holding longer-dated bonds, matters because it influences mortgage rates and corporate borrowing costs independent of the Fed's overnight rate. If term premiums drift up because of supply, inflation risk, or uncertainty, equities can face a headwind even without another Fed hike. It's like running into the wind. You can still move forward, but it's harder.
Sentiment is another layer. Surveys and positioning data have shown bouts of optimism, understandable when indices are at highs. But optimism isn't inherently a sell signal. Bull markets climb on improving fundamentals and investor confidence. What matters is whether optimism translates into froth, excess leverage, reckless IPOs, or speculative mania spilling into areas with no earnings. We've seen some pockets of speculation, yes, but it doesn't feel like a market drowning in euphoria across the board. Far from 2021's everything goes vibe.
Complacency is the subtle cousin of euphoria. Low volatility can lull investors into a false sense of safety. When the sea looks calm, people venture farther from shore. Then a squall hits, and the scramble back can be messy. Risk doesn't announce itself. It accumulates. Derivative positioning, volatility selling, and crowded trades can create air pockets. You don't need wild speculation everywhere. You just need a crowded doorway when someone yells, "Fire."
So, scenarios. Base case for the bullish camp, a soft landing. Inflation grinds down without a deep recession, the Fed begins to ease methodically, credit remains available, and earnings grow as AI-driven productivity offsets wage and input costs. In that world, multiples don't need to expand dramatically to deliver reasonable returns. Earnings can do the heavy lifting. Market leadership can broaden as rate-sensitive sectors get relief.
And the cautionary scenarios. 1. A delayed hard landing. The cumulative effect of higher rates shows up suddenly in the job market. Unemployment rises, consumer spending softens, earnings fall, and valuations compress simultaneously. 2. A no landing or re-acceleration of inflation. Growth stays hot, inflation stops cooling, and the Fed either keeps rates high longer or tightens further, pressuring multiples. 3. An exogenous shock. Geopolitics, energy supply disruption, or a financial accident in a corner of the market that's been off the radar. Oh, like the CLO issue.
Whichever path unfolds, the wallet impact is real. Soft landing, job stability, manageable borrowing costs, and steady asset growth. Good for household planning. Hard landing, tighter job markets, more expensive credit, and equity volatility. Households might delay big-ticket purchases or adjust retirement timelines. No landing with sticky inflation, elevated living costs, and higher debt service. Budgets get squeezed even if nominal wages grow. That's why people should understand how an index's structure and the economy's plumbing interact, even if they never trade a single stock.
A practical translation. If your retirement plan is tied to a market cap-weighted index, a disproportionate chunk of your future rides on a small number of companies. If credit spreads widen, Your mortgage rate or your company's financing costs can go up, even if you're not directly in the market. If unemployment rises, it changes bargaining power on wages. The market's mood feeds back into the real economy via confidence, hiring, and investment. That's the loop to watch.
Let's also acknowledge global currents. While the US often sets the tone, international markets, supply chains, and currencies affect earnings for multinationals. Some overseas central banks are already adjusting policy as their inflation trajectories differ. That can alter global liquidity conditions and trade flows. For the US market, a weaker or stronger dollar can shift reported revenue for global companies and influence sector leadership too.
And geopolitics, conflicts, trade tensions, and election outcomes can reshape regulatory risk, tax policy, and corporate strategy. Markets can digest known risks. They struggle with surprises. The higher the valuation starting point, the less shock absorption you have. In a low valuation world, good news isn't required to go up. In a high valuation world, good news may be required just to stand still.
We should circle back the bull versus bear case. The essence of that debate, echoed across Wall Street, is whether the market is discounting a reasonable glide path to better growth and lower inflation or setting itself up for disappointment. The bull case is anchored in resilient earnings, transformative tech investment, and the potential for policy to gradually ease. The bear case flags valuations, concentration, and tightening liquidity that could bite when sentiment shifts.
And in truth, both sides can be right over different horizons. Short-term, momentum and liquidity can carry markets farther than skeptics believe. Medium-term, gravity, valuations, earnings cycles, and policy realities asserts itself. Long-term, innovation and productivity lift living standards and corporate profits, but with long, uneven paths. The danger is extrapolating today's pace indefinitely.
So, is the bull market alive and well? My answer, yes, with caveats. Underlying corporate performance in key sectors is strong. The AI and automation cycle is early, and there are credible paths to easing policy as inflation cools. The rally isn't solely sentiment-driven. It's got earnings under it. It's like a plane with strong engines, capable of climbing further, especially if headwinds ease.
And I'd say, the warning signs aren't sirens, but they're not whispers either. Valuations leave less room for error, leadership concentration increases fragility, and liquidity is less abundant at the margins than it appears from the index's altitude. That plane you mentioned? It's flying high. The engines are powerful, but the air is thin, and any turbulence will feel sharper. In such conditions, small shocks can produce big altitude changes.
For listeners thinking, what do I do with this? Remember, the goal here isn't to make a call for tomorrow. It's to understand the forces in play: earnings, rates, liquidity, leadership, and sentiment. Recognize how index construction amplifies the influence of the largest companies and how the economy's plumbing can either lubricate or clog the system. From there, one can appreciate why markets can keep pushing higher and why they can also slam on the brakes unexpectedly.
And appreciate the impact on your everyday life even if you never buy a share directly. Market cycles influence hiring decisions, wage growth, home affordability, and the cost of debt. They shape tax revenues and public services. When we say markets are at all-time highs, it isn't just a chart. It's a signal about risk appetite and financial conditions that will touch your wallet, even if indirectly.
Final thought from the constructive side. Innovation has a way of surprising on the upside. We chronically underestimate the compounding effects of new tools, software, AI, automation, on productivity. If that tailwind persists, the economy can carry higher valuations than traditional models assume. Combine that with cautious central banks gradually normalizing policy, and you get a scenario where dips are digestible, not devastating.
Final thought from the skeptical side. Cycles don't die of old age, but they do end when the inputs change. Keep an eye on the price you're paying for growth, on how many horses are actually pulling the cart, and on whether the water level of liquidity is rising or falling. Highs can be a sign of strength, and also a point from which gravity exerts more pull. Respect both possibilities.
So we land here, optimism with eyes open. The bull market case rests on real earnings and real innovation. The cautionary case rests on valuation math, market structure, and policy plumbing. Whichever camp you lean toward, understanding these forces gives you a better map for the road ahead, even knowing that the road will twist.
Agreed. The question, bull run or warning signs, isn't a binary switch. It's a dashboard. Today, several gauges read strong, a few blink yellow. Watching how those needles move, earnings, inflation, rates, breadth, credit, will tell us whether this ascent continues smoothly or whether it's time to fasten seatbelts.
Disclaimer. This dialogue is an informational synthesis of the provided news and is not investment, legal, tax, or financial advice. No recommendation or solicitation is being made.